सजनी रे कैसे कटे दिन रात, कैसे हो तुझसे बात, तेरी याद सतावे रे। ओ सजनी रे कैसे कटे दिन रात, कैसे मिले तेरा साथ, तेरी याद सतावे रे। कैसे घनेरे बदरा घिरे तेरी कमी की बारिश लिए, सैलाब जो मेरे सीने में है, कोई बताए ये कैसे थमे, तेरे बिना अब कैसे जिए। ओ सजनी रे कैसे कटे दिन रात, कैसे हो तुझसे बात, तेरी याद सतावे रे। ओ सजनी रे कैसे कटे दिन रात, कैसे हो तुझसे बात, तेरी याद सतावे रे। वे कमलिया वे कमलिया वे कमलिया मेरे नादान दिल वे कमलिया वे कमलिया वे कमलिया मेरे नादान दिल दो नैनों के पेचीदा सा गलिया रे इनमें खोकर तू मिलता है कहाँ तुझको अंबर से पिंजरे ज्यादा प्यारे उड़ जा कहने से सुनता भी तू है कहाँ गल सुन ले गल सुन ले वे कमलिया मेरे नादान दिल वे कमलिया वे कमलिया वे कमलिया मेरे नादान दिल क्या करना है तो प्यार करे पूरी मेरी बात कमलिया वे कमलिया मन मर्जी करके देख ले सब कुछ हार कर कमलिया वे कमलिया मर्जी तेरी जी भर ले वे कमलिया मेरे नादान दिल वे कमलिया वे कमलिया वे कमलिया मेरे नादान दिल आधा तेरा इश्क आधा मेरा ऐसे हो पूरा चंद्रमा ओ तारा तेरा एक तारा मेरा बाकी अंधेरा आसमां न तेरे संग लागे बांधे जो पीपल पे धागे इस सुरम के धारे बहते हैं नजरे बचा के बदरंग में सतरंगा है इश्क रे जोगी में और गंगा है इश्क रे बदरंग में सतरंगा है इश्क रे जोगी में और से लगा लूं हाथ, छू के मैं पैर तेरे, हो रख लूं मैं तन पे जख्म, बना सारे बैर तेरे। रुकना नी तू हुण रुसड़ा नी मैं, तेरा नी रहा तेना खुद दा भी मैं। दुनिया तू ही है मेरी पर नाना, अब नाना मैं नहीं आना। शहर तेरे जो फिर संग लागे, रखते वो हमको जला के, वो आधे झूठे वादे ले जा तू कसमें लगा के। रग रग में मलंगा है ये इश्क रे, क्यों लहू में ही रंगा है ये इश्क रे। हो बदरंग में सतरंगा है ये इश्क रे, जोगी में और गंगा है ये इश्क रे। तू मेरी सारी यादें पानी में आज बहा दे, ये तेरी भीगी आंखें रख लूं लबों से लगा के। मैं समंदर परिंदा है ये इश्क रे, मन मातम और जिंदा है ये इश्क रे। हो बदरंग में सतरंगा है ये इश्क रे, जोगी मैं और गंगा है ये इश्क रे। ओ बदरंग में सतरंगा है ये इश्क रे, जोगी मैं और गंगा है ये इश्क रे। बेरंगे थे दिन, बेरंगी शामें आई है तुमसे रंगियां। फीके थे लम्हे जीने में सारे, आई है तुमसे नमकीनियां। बेइरादा रास्तों की बन गए हो मंजिलें, मुश्किलें हर है तू ही से या तू ही हो।
सवालों में उलझे, उनके जवाबों के जैसे मिले झरने ठंडे पानी के, हो रवानी में ऊंचे पहाड़ों से बहके, ठहरे तालाबों से जैसे मिले। तुम क्या मिले, तुम क्या मिले, हम ना रहे हम, तुम क्या मिले।
जैसे मेरे दिल में खिले फागुन के मौसम, तुम क्या मिले, तुम क्या मिले, तुम क्या मिले, हम ना रहे हम, तुम क्या मिले, तुम क्या मिले, तुम क्या मिले, तुम क्या मिले, तुम क्या मिले। फलक से मैं सितारे तोड़ के जमीन पे लाऊंगा, इजाजत दे जहां भी हो तेरी खुशी ले आऊंगा। कोई जगह ना पता जहां न तू हो दिखा, तेरे नाम से शुरू है हर दुआ, तेरे नाम से नाम जुड़ा के, तेरी राह में शाम सजा के, रब तुझको मान लिया जो तेरे संग इश्क हुआ। वो तेरे नाम से नाम जुड़ा के, तेरी राह में शाम सजा के, रब तुझको मान लिया जो तेरे संग इश्क हुआ।
शहर में हूँ, तूने मुझे बसा दिया, तू है किनारा तो लहर में हूँ, आके तुझे है छू लिया।
तेरी सांसों में घुल गया हूँ, तेरे छूने से खिल गया हूँ, तेरी बातों ने ये क्या कर दिया। कोई जगह ना पता जहां तू हो दिखा, तेरे नाम से शुरू है हर दुआ, तेरे नाम से नाम जुड़ा के, तेरी राह में शाम सजा के, रब तुझको मान लिया जो तेरे संग इश्क हुआ। तेरे नाम से नाम जुड़ा के, तेरी राह में शाम सजा के, रब तुझको मान लिया जो तेरे संग इश्क हुआ। तेरे संग, तेरे संग, तेरे संग इश्क हुआ, इश्क हुआ, इश्क हुआ। तेरा रंग जैसे इश्क वर्गा, इश्क का रंग तो है रब वर्गा, रब का रंग तो है पानी सा साफ, पानी का रंग तो है तेरी रूह वर्गा। ऊंची ऊंची दीवारों को लांघ के आना पड़ेगा, ऊंची ऊंची दीवारों को लांघ के आना पड़ेगा। सारी खुशियाँ साथ समेटे बांध के आना पड़ेगा, हो साथ कंगन लेके आना, थोड़े बंधन लेके आना, हाँ निभाएंगे हम मिलके, हाँ थोड़ी बातें लेके आना, सारी रातें लेके आना, गुजारेंगे हम मिलके। ऊंची ऊंची दीवारों को लांघ के आना पड़ेगा। लांघ के आना पड़ेगा। ये शोखी ये शरारत ये नफासत नजाकत, ये शोखी ये शरारत ये नफासत नजाकत, बहुत खूबसूरत हो, बहुत खूबसूरत हो, आप सर से पाँव तक दिल झूम झूम, दिल झूम झूम, दिल झूम झूम जाए, दिल झूम झूम, दिल झूम झूम, दिल झूम झूम जाए। तुम्हें हूर हूर किसी हूर हूर, हाँ हूर साए पाए, दिल झूम झूम, दिल झूम झूम, दिल झूमता रह जाए। सबसे जुदा है तेरी अदाएं, दिल तेरा कायल हो ही गया, जुल्फे ये तेरी काली घटाएं, धूप में बादल मिल ही गया, ये तेरी निगाहें करम फरमा है, तू मुझ पे हुआ मेहरबान, मैं कैसे भुलाऊं आपकी नाम। खूबसूरत हो, आप सर से पाँव तक। दिल झूम झूम, दिल झूम झूम, दिल झूम झूम जाए। दिल झूम झूम, दिल झूम झूम, दिल झूम झूम जाए। तुम्हें हूर हूर किसी हूर हूर, हाँ हूर साए पाए। दिल झूम झूम, दिल झूम झूम, दिल झूम तरह जाए। बातें तेरी जैसे दुआएं, मैं इनमें शामिल हो ही गया। दिल में तुम्हारे थोड़ा सा हिस्सा, हाँ मुझको हासिल हो ही गया। ये दिल भी तुम्हारा तुम्हारी तरह है, जो खुशियाँ मुझे दे रहा हो तुम। जिस भी जगह पे वहीं पे हो रौनक। बहुत खूबसूरत हो, बहुत खूबसूरत हो, आप सर से पाँव तक। दिल झूम झूम, दिल झूम झूम, दिल झूम झूम जाए। दिल झूम झूम, दिल झूम झूम, दिल झूम झूम जाए। तुम्हें हूर हूर किसी हूर हूर, हाँ हूर साए पाए। दिल झूम झूम, दिल झूम झूम, दिल झूम तरह जाए। झूम तरह जाए। खुदा अब बनाता नहीं ऐसे चेहरे, निगाहें ये जा जा के हाँ जिन पे ठहरे। जिन्हें देखने से मिले दिल को राहत, बहुत खूबसूरत हो, आप सर से पाँव तक। मन जोगिया जोगिया, एक तू ही जोग है मेरा। दिल हो गया रोगिया, तू ही रोग है मेरा। मन जोगिया जोगिया, एक तू ही जोग है मेरा। दिल हो गया रोगिया, तू ही रोग है मेरा। उम्र भर मैं तेरी परवाह करूं कि मर जाऊं, जो तुझे रुसवा करूं। तू सपने देखे जिन्हें मैं पूरा करूं, कि अब तो रब भी है दूजा, पहला है तू। नेह का धागा जो लगायूं, ना तोड़ जाना तू, ना छोड़ जाना तू, ना छोड़ जाना तू।
नेह का धागा जो लगायूं, ना तोड़ जाना तू, ना छोड़ जाना तू, ना छोड़ जाना तू।
जचता नहीं, दिल पे जो नाम और कोई रचता नहीं।
तेरे बिना मैं, मेरे बिना तू जचता नहीं, दिल पे जो नाम और कोई रचता नहीं। हाँ संग तेरा जरूरी है, नाम मंजूर दूरी है, मेरे हंसने पे रोने पे हक बस है तेरा।
ये हर सुबह देखूं मैं चेहरा तेरा, तू सांसें बन जा मैं धड़कूं दिल की तरह। हाँ मेरी पलकों से ओझल होना तू ना, कि तुझको देखे बिना ना रह पाऊंगा।
मन जोगिया जोगिया एक तू ही जोग है मेरा, दिल हो गया रोगिया और तू ही रोग है मेरा।
मन जोगिया जोगिया एक तू ही जोग है मेरा, दिल हो गया रोगिया तू ही रोग है मेरा। नेह का धागा जो धागा यूं ना तोड़ जाना तू, ना छोड़ जाना तू, ना छोड़ जाना तू।
का धागा जो लगा यूं ना तोड़ जाना तू, ना छोड़ जाना तू, ना छोड़ जाना तू।
कैसे ये बीते दिन रब जाने दिल जाने, तेरा तराना तेरी धुन मिलके गले तेरी यादों के साए से, दिल का लगाना था शगुन। तेरे सदके मेरी सारी जिंदगी राजना राजना वे राजना मेरे यार वे राजना राजना वे राजना मेरे यार। राजना राजना वे राजना मेरे यार वे राजना वे राजना वे राजना। क्यों मेरी आहटों से पर्दा, क्यों मेरी चाहतों से पर्दा, किसी से प्यार करना है मना। राजना राजना वे राजना मेरे यार वे राजना राजना वे राजना मेरे यार। सर्दी हवाओं में तेरी तस्वीरें बेताबियों को बढ़ाती हैं। सुनी निगाहों को रंग मिल जाए, आंखों में कोई ख्वाब सजाए क्या ये रुक सी गई थी ये सांसों की कहानी, तुमसे मिले फिर चला ये दिल। तेरे कदमों से कदम मिला के साथ चले, तुझे साथी बना के क्या ये हक भी जताना है मना। राजना राजना वे राजना मेरे यार वे राजना, राजना वे राजना मेरे यार, राजना राजना वे राजना मेरे यार वे राजना, राजना वे राजना, राजना राजना वे राजना मेरे यार वे राजना, वे राजना वे राजना मेरे यार, राजना राजना वे राजना मेरे यार वे राजना, वे राजना वे राजना। तुमसे दिल जब से मिला है, कोई तो वजह है, इश्क हुआ है। इतनी सी बात समझ लो, सारे जहां में तुमसे हुआ है। ओ लाखों मिले कोई भी न तुम सा मिला, ओ मेरा ये दिल तेरी ओर चलता गया ना रुका। मेरे यारा मेरे यारा मान जाना, मेरे यारा आके मुझे थाम ले, तू भी मेरा नाम ले। मेरे यारा मेरे यारा मान जाना, मेरे यारा। ओ तेरी मेरी बातें होती रहे, ऐसी मुलाकातें होती रहे, तू जो मेरे पास रहे, जादू सा यूं चलता रहे।
होना है जिससे वो हो जाने दो, खोना है इससे तो खो जाने दो, दूर से तो होगा नहीं, थोड़ा तो करीब आने दो।
ओ लाखों मिले कोई भी न तुम सा मिला, ओ मेरा ये दिल तेरी ओर चलता गया ना रुका। मेरे यारा मेरे यारा मान जाना, मेरे यारा
आके मुझे थाम
तू मेरा कोई ना होके भी कुछ लागे, तू मेरा कोई ना होके भी कुछ लागे। कि यारे जो भी तूने कैसे किया रे, जिया को मेरे बांध ऐसे लिया रे, समझ के भी ना समझ मैं सकूं सवेरों का मेरे तू सूरज लागे, तू मेरा कोई ना होके भी कुछ लागे। अपना बना ले दिया, अपना बना ले दिया, अपना बना ले मुझे, अपना बना ले दिया, अपना बना ले दिया, अपना बना ले दिया। दिल के नगर में शहर तू बसा ले दिया। छूने से तेरे हाँ तेरे फिक्र तो को रंग लगे, तेरी दिशा में क्यों चलने से मेरे पैरों को पंख लगे। रहने मेरे काम का जग सारा हो बस तेरे नाम से ही गुजारा, उलझ के यूं ना सुलझ ना सकूं। जुबानियां तेरी झूठी भी सच लागे, तू मेरा कोई ना होके भी कुछ लागे। अपना बना ले दिया, अपना बना ले मुझे, अपना बना ले दिया। ओ सब कुछ मेरा चाहे, नाम अपने लिखा ले, बदले में इतनी तो यारी निभा ले। जग की हिरासत से मुझको छुड़ा ले, अपना बना ले, बस अपना बना ले। अपना बना ले दिया, अपना बना ले दिया, अपना बना ले मुझे, अपना बना ले दिया। मिला हूँ अब जो तुमसे, है दिल को मेरे कसम से सुकून मिला, सुकून मिला। तुझे है पाया रब से, है दिल को मेरे कसम से सुकून मिला, सुकून मिला। हर पल हंसी सा हुआ है, सांसों को तूने छुआ है, बड़ी तुझसे नजदीकियां, सुकून मिला, सुकून मिला। मिला हूँ अब जो तुमसे, है दिल को मेरे कसम से सुकून मिला, सुकून मिला। जब से जुड़ा तुझसे जिया चैनो करार दिल को मिला। जब से जुड़ा तुझसे जिया चैनो करार दिल को मिला। जब भी रहूं संग तेरे भूलूं हर गम शिकवा गिला। तेरे इश्क का ही नशा है मेरी रूह तक में बसा है। तूने आंखों से जो छुआ सुकून मिला, सुकून मिला। मिला हूँ अब जो तुमसे है दिल को मेरे कसम से सुकून मिला, सुकून मिला। बदले तेरे माही लाके जो कोई सारी दुनिया भी दे दे अगर तो किसे दुनिया चाहिए। तू है तो मुझे फिर और क्या चाहिए। तू है तो मुझे फिर और क्या चाहिए। किसी की ना मदद ना दुआ चाहिए। तू है तो मुझे फिर और क्या चाहिए। चाहिए तू है तो मुझे फिर और क्या चाहिए। तू है तो मुझे फिर और क्या चाहिए। किसी की ना मदद ना दुआ चाहिए। तू है तो मुझे फिर और क्या चाहिए। जब तक तेरी नींद न टूटे उगता नहीं है सूरज मेरा। जब तक तेरी नींद न टूटे उगता नहीं है सूरज मेरा। ख्वाब रहे किस काम के मेरे ख्वाब से प्यारा तू सच मेरा। सुन जिंद जख्मों को मेरे मरहम की जगह बस तेरा छुआ चाहिए। तू है तो मुझे फिर और क्या चाहिए। तू है तो मुझे फिर और क्या चाहिए। किसी की ना मदद ना दुआ चाहिए। तू है तो मुझे फिर और क्या चाहिए।
everyone, and welcome to this trading course. I'm really excited that you're here, ready to embark on a journey that can transform your understanding of the financial markets and, with the right dedication, your personal finances. I'm Vicente, and I'll be your guide throughout these lessons. I've been in this industry for over 9 years, seeing both its brightest and harshest sides. My goal with this course is to demystify the world of trading, make it accessible, and, above all, teach you how to trade in an informed, disciplined, and responsible way. This course is designed to take you from scratch, assuming you have little to no prior knowledge, to a level where you can understand the markets, analyze opportunities, and make your own informed trading decisions. We'll cover everything from basic terminology to strategies and the psychology needed for success. So, if you've ever wondered how trading really works, you're in the right place. Let's get started. What is trading and how does it differ from investing? Alright, let's start with the very basics. What exactly is trading? In essence, trading is the activity of buying and selling financial instruments such as company stocks, currencies from different countries, cryptocurrencies, commodities like gold or oil, among others, with the primary goal of profiting from their price fluctuations. Now, it's very important to differentiate trading from investing, although the terms are sometimes used interchangeably. The main difference lies in the time horizon and, often, in the methodology. An investor generally buys assets with the intention of holding them long-term weeks, months, years, or even decades. They seek growth in the asset's value over time, and perhaps passive income like dividends in the case of stocks. The investor usually focuses on the fundamental intrinsic value of what they buy. A trader, on the other hand, seeks to profit from shorter price movements. They might hold an open position for a few minutes, hours, days, or a few weeks, but rarely for years. The trader is more focused on volatility and price direction in the short or medium term. While fundamental analysis can be part of their arsenal, technical analysis, which studies price patterns and volume, is usually a primary tool for the trader. In summary, investing is like planting a tree and waiting for it to grow and bear fruit over time. Trading is more like surfing waves. You look for the right wave, ride it while it lasts, and then look for the next one. Both activities have their place and can be profitable, but they require different approaches and skills. In this course, we will focus specifically on trading, realistic expectations, potential and risks of trading. Let's now talk about something crucial: expectations. It's vital that you enter the world of trading with a realistic perspective, understanding both its potential and, this is very important, its risks. The potential of trading is, without a doubt, attractive. It offers the possibility of generating additional income or even turning it into a primary source of income. It provides flexibility, as you can trade from almost anywhere with an internet connection. And for many, it represents a stimulating intellectual challenge, constantly learning about economics, finance, and human behavior. However, and I want to be very clear about this, trading is not an easy or quick path to wealth. It requires study, practice, discipline, and very strict risk management. The main risk is, of course, capital loss. All capital you allocate to trading is at risk. That's why a golden rule is, never trade with money you cannot afford to lose. Never use money intended for your basic needs, such as rent, food, or your children's education. Besides the financial risk, there's an emotional component. Losing trades are inevitable and can be frustrating. The pressure of making quick decisions under uncertainty can generate stress. Greed can lead you to take excessive risks, and fear can make you close trades prematurely or miss good opportunities. In this course, we are not going to sell you the idea that you'll become a millionaire overnight. That's unrealistic and dangerous. Our goal is to equip you with the knowledge, tools, and mindset so you can make informed decisions, manage risks effectively, and seek sustainable profitability over time. Success in trading is built with patience and consistency, not strokes of luck. Mindset of a successful trader: discipline, patience, and objectivity. We've already touched a bit on the emotional aspect, but I want to dedicate a section to the trader's mindset because it is, without exaggeration, one of the most determining factors for long-term success. You could have the best strategy in the world, but if your psychology isn't right, you're very likely to fail. 3 fundamental pillars of a successful trader's mindset are discipline, patience, and objectivity. First, discipline. This means having a clear trading plan and following it rigorously. Your plan should define what you will trade, when you will enter a trade, when you will exit, and how much capital you will risk on each trade. Discipline is the ability to execute your plan without deviating due to impulses, emotions, or gut feelings. It's doing what you have to do when you have to do it, even if you don't feel like it. Second, patience. Patience in trading is twofold. On one hand, you need patience to wait for the right opportunities. Not all market fluctuations are a signal to trade. Sometimes, the best trade is no trade at all. You must wait for the market to show you conditions that align with your strategy. On the other hand, you need patience with your results. Trading is a marathon, not a sprint. There will be good streaks and bad streaks. Developing skill and consistency takes time. Third, objectivity. This involves analyzing the market and your own trades as impartially as possible, without letting your emotions or personal biases cloud your judgment. If a trade goes against you, you must be able to recognize it and act according to your plan instead of hoping the market will magically turn around. Objectivity also means learning from your mistakes without beating yourself up too much and celebrating your successes without becoming you. Developing these qualities is not easy. It requires self-awareness and constant practice. Throughout the course, we will revisit these topics because they are vital. Prerequisites, capital, time, and basic tools. Finally, in this introductory module, let's briefly talk about the prerequisites for starting in the world of trading. First, capital. As we mentioned before, you will need capital to trade. The exact amount can vary greatly, depending on the market you want to trade in and the broker you choose. There's no magic number, but it must be risk, capital that is, money that, if you lose it, will not affect your quality of life. Later on, we'll talk about demo accounts, which are a fantastic tool for practicing without risking real money, and are an indispensable preliminary step before trading with your own capital. Second, time. Trading requires a significant time investment, time to learn the concepts, as you are doing now, time to practice on a demo account, time to analyze markets and look for opportunities, and time to manage your trades once they are open. You don't have to be glued to the screen 24/7, especially if you choose trading styles that are not interesting, but you do need to dedicate consistent and sustained effort, especially at the beginning. Third, basic tools. You'll need a computer with a stable and reliable internet connection. A smartphone can also be useful for following the market or managing trades, but for in-depth analysis, a larger screen is recommended. You will also need to choose a broker, which is the company that will provide you with access to the markets and a trading platform. The trading platform is the software you will use to view charts, perform analysis, and execute your buy and sell orders. Don't worry, in later modules, we will delve deeper into how to choose a broker and how platforms work. And, of course, the most important requirement is the willingness to learn and dedication. Trading is a skill that develops with time and effort. With this, we conclude our Module 0. We've laid the groundwork. What trading is, how it differs from investing, what realistic expectations are, the importance of mindset, and the basic requirements to get started. I hope this introduction has given you a clear overview and motivated you to continue. Let's continue with the next module. Module 1. Understanding Financial Markets. 1.1. Types of financial markets. Financial markets are, in essence, places, whether physical or increasingly virtual, where various financial instruments are bought and sold. There are diverse types of markets, each with its own unique characteristics, a variety of assets, and distinct market dynamics. We're going to explore some of the most relevant ones for trading purposes. Now, 1.1.1, Forex market. Let's start with the largest and most liquid financial market in the entire world, the foreign exchange market, commonly known as Forex, or simply FX. This global marketplace is where the currencies of different countries are actively traded against one another. Think of it as a giant global exchange where, instead of common goods, euros are exchanged for US dollars, Japanese yen for British pounds, and so on, in a continuous flow. Forex trading primarily involves speculating on the anticipated fluctuation of the exchange rate between two specific currencies. For example, if you believe the euro will strengthen significantly against the US dollar, you would proceed to buy the Euro-USD currency pair in that scenario. If your analysis is correct and the euro indeed rises in value relative to the dollar, you successfully make a profit from that particular trade. One of the great advantages of the Forex market is its exceptionally high liquidity, which generally means it's easy. It means it's easy to buy or sell currencies without significantly affecting their prevailing market price. Additionally, it operates 24 hours a day, 5 days a week, due to the convenient overlap of major global financial sessions. These sessions include Sydney, Tokyo, London, and the very active New York trading period, creating constant opportunities. 1.1.2. Stock market. The stock market, also commonly known as the stock exchange, is the specific marketplace where shares of publicly traded companies are bought and sold by investors and traders. When you purchase a share of stock in a company, you effectively become an owner of a small fractional part of that particular business entity. Stock traders can seek to profit from anticipated increases in share prices or, in some specific cases, from expected declines in value. The intrinsic value of any given stock can be affected. It can be affected by many different factors, including the company's underlying financial performance, relevant industry news and developments, the overall health and sentiment of the broader economy, and various other market-specific influences. Examples of major stock exchanges around the world include the New York Stock Exchange, the tech-heavy Nasdaq, the London Stock Exchange. Other major exchanges are the Tokyo Stock Exchange, among many others operating globally. These exchanges facilitate the orderly buying and selling of company shares, playing a crucial role in capital formation and price discovery for publicly listed corporations across numerous sectors and diverse industries around the world, fostering economic growth and investment opportunities. 1.1.3. This is a relatively new market, but one that has gained enormous popularity and widespread attention in recent years. The cryptocurrency market, here various digital assets such as Bitcoin, Ethereum, Ripple, and indeed thousands of other alternative coins, often referred to as altcoins, are actively traded by a growing number of participants globally. Cryptocurrencies utilize advanced cryptography to secure their transactions and to control the creation of new units of the digital currency. They are predominantly decentralized in nature, meaning they are not typically controlled by a central bank or any single government entity, for the most part, offering a different paradigm for financial assets. This particular market is well known for its characteristic high volatility, which can present significant opportunities for profit, but also entails substantial risks for traders and investors alike. It operates continuously, 24 hours a day, 7 days a week, and trading is primarily conducted through specialized cryptocurrency exchanges or via brokers offering CFDs or contracts for difference on various crypto assets allow traders to speculate on price movements without owning the underlying digital coins themselves. This accessibility and constant operation contribute to its dynamic and often unpredictable nature, attracting both seasoned traders and newcomers to the space seeking diverse investment options and potential returns. 1.1.4. Commodities market. The commodities market is the specific marketplace where basic goods and essential natural resources are actively traded among various participants. These traded commodities can be broadly divided into several distinct categories to better understand their nature. Energies, for instance, include crucial resources such as crude oil and natural gas. Precious metals form another category, featuring items such as gold, silver, and platinum, often seen as safe haven assets. Industrial metals, vital for manufacturing and construction, include commodities like copper and aluminum. Lastly, agricultural products encompass a wide range of items like corn, wheat, soybeans, coffee, and sugar, essential for global food supplies. Commodity prices can be significantly affected by a multitude of factors. These include global supply and demand dynamics, influential geopolitical events that can disrupt production or trade flows, prevailing weather conditions, especially for agricultural commodities, and the relative strength of the US dollar, as many commodities are quoted and traded in this currency. 1.1.5. Futures and options market. These are considered derivative markets, meaning their intrinsic value is directly derived from an underlying asset. This underlying asset can be a currency, a stock, a commodity, or even an index. A futures contract, for example, is a standardized agreement to either buy or sell a specific asset at a predetermined price. This transaction is set to occur on a specific future date. Futures contracts are widely used by various market participants, both for hedging existing risks and for speculative trading purposes. Options, on the other hand, give the buyer the right, but importantly, not the obligation, to buy or to sell. To sell an underlying asset at a set price, known as the strike price, on or before a specific expiration date. The seller of the option, in contrast, has the obligation to fulfill the terms of the contract if the buyer decides to exercise their right. Options are generally more complex instruments. They require a deep and thorough understanding of their mechanics, pricing, and associated risk profiles before one should consider trading them actively in the financial markets. Their versatility makes them popular for various strategies, but caution is advised due to their complexity and the potential for significant losses if not managed properly. 1.1.6. Stock index market. A stock market index is essentially a statistical measure that accurately reflects the overall performance of a specific group of stocks from a particular market or a defined sector. Instead of trading an individual stock and its unique risks, you can effectively trade on the aggregate performance of the entire underlying index itself. Some well-known examples of major stock indices include the S&P 500, which groups the 500 largest publicly traded U.S. companies, and the Dow Jones Industrial Average, tracking 30 large U.S. companies. Internationally, prominent indices include the FTSE, representing the 100 largest UK companies, and the DAX from Germany. Trading indices allows investors and traders to gain broad exposure to a wider market segment without needing to meticulously select and analyze individual stocks. It can also be a strategic way to speculate on the general direction of the overall economy or a specific industrial sector, offering diversification and a macroeconomic perspective on investments. 1.2. Market participants. Now that we know the various types of financial markets, let's look at who the key players are that actively participate in them. We can broadly divide these participants into several main categories to understand their roles and influence. Central banks, such as the U.S. Federal Reserve, the European Central Bank, or the Bank of Japan, play a crucial role. Their main responsibility is to manage a country's or a region's monetary policy, control inflation rates, and stabilize the national currency. Their decisions, such as making changes to benchmark interest rates, can have an enormous and immediate impact on all financial markets globally. Commercial banks and various financial institutions are also major players, typically operating with very large volumes of capital. They trade both for their own accounts, a practice known as proprietary trading, and also on behalf of their diverse clientele. This group includes investment banks, hedge funds, large pension funds, and major insurance companies. Their collective activity generates a substantial part of the overall market's liquidity, ensuring smooth price discovery and transaction flow. Large corporations, especially multinational companies, also participate in financial markets primarily to manage currency risks. If they operate in multiple countries, to obtain necessary financing for their operations, or to invest any surplus cash effectively. Retail traders are where we, as individual traders, come into the picture. We trade with our own personal capital, usually through easily accessible online brokers that provide trading platforms and market access. Although our individual trading volume is relatively small compared to that of large institutions, collectively, retail traders represent a growing and significant part of the overall market, influencing price movements and contributing to liquidity. Brokers and market makers are also essential participants. Brokers act as crucial intermediaries, connecting individual traders and other entities to the broader financial markets. Market makers are entities that actively provide liquidity by consistently quoting both buy and sell. They quote buy and sell prices for a particular asset, profiting from the spread, which is the small difference between these quoted prices. Understanding who all these participants are helps you to comprehend the complex forces that move market prices and the general underlying structure of the financial markets you are trading in more clearly. 1.3. How markets work: supply, demand, liquidity, and volatility. The fundamental engine that consistently drives prices in any given market is the dynamic interaction between supply and demand for an asset. Supply refers to the total amount of an asset that sellers are willing to offer to the market at a specific given price point. Demand, conversely, represents the amount of that same asset. Demand is the amount that buyers are willing to acquire at a particular given price. If the demand for an asset significantly exceeds the available supply, the price of that asset tends to rise, as eager buyers are often willing to pay more to obtain it. Conversely, if the supply of an asset exceeds the current demand, the price tends to fall, as sellers may need to lower their prices to attract potential buyers. When supply and demand are relatively balanced, the price of the asset tends to stabilize around an equilibrium level. Two key concepts closely related to this dynamic are liquidity and market volatility, which are crucial for traders. Liquidity refers to the ease with which an asset can be bought or sold quickly in the market without causing a significant change in its prevailing price. A highly liquid market has many active buyers and sellers constantly participating. This generally translates into lower spreads, meaning a lower cost to trade, and also less risk. Less risk of not being able to close a position at the desired price level. The Forex market is a prime example of a very liquid market. Volatility, on the other hand, measures the magnitude of an asset's price fluctuations over a given period. A highly volatile asset experiences large and often rapid price changes. High volatility can offer more potential trading opportunities, but also inherently involves greater risk for traders. Cryptocurrencies, for example, are well known for their characteristic high volatility, which attracts many speculators but also necessitates careful risk management strategies to navigate the potential for swift and substantial price swings in either direction. 1.4. Key trading terminology. To navigate the financial markets effectively, you need to understand their specific language. Here are some essential terms you'll hear and use constantly. PIP, which stands for percentage in point, is the smallest unit of price change for a currency pair in the Forex market. For most currency pairs, a pip is typically the fourth. A pip is the fourth decimal place. For instance, if the Euro-USD pair moves from 1.1050 up to 1.1051, it has risen by exactly 1 pip. However, in currency pairs involving the Japanese yen, the pip is usually the second decimal place. Lot represents the standardized size of a trade in Forex. A standard lot is equivalent to 100,000 units of the base currency. There are also mini lots, which are 10,000 units, and micro lots, representing 1,000 units. The lot size you choose directly affects the monetary value of each pip movement in your trade. Spread is the critical difference between the buy price, and the sell price of any given financial asset. It's basically the inherent cost of opening a trade and serves as the primary way many brokers earn their income. Logically, a lower or tighter spread is generally better for the trader, as it reduces transaction costs significantly over time. Swap, also known as rollover, in Forex, is the interest that is either paid or received for holding a trading position open overnight. Its value depends on the prevailing interest rates of the two currencies involved in the traded pair, and also on whether your specific position is long or short. Bid and ask prices are fundamental. Bid is the price at which the market, or your broker, is willing to buy an asset from you. It's the price at which you, as a trader, can sell. Ask, also known as offer, is the price at which the market, or your broker, is willing to sell an asset. It's the price at which you, as a trader, can buy that asset. The ask price is always slightly higher than the bid price, and this difference constitutes the spread. Slippage occurs when your trade order is executed at a different price than the one you initially requested when placing the order. This can happen in highly volatile or low liquidity market conditions, especially when using market orders for execution. Slippage can be negative, meaning a worse execution price, or positive, resulting in a better price, although negative slippage is generally more common. Leverage is a powerful tool that allows you to trade with more capital than you actually have deposited in your trading account. The broker effectively lends you the difference. For example, with a 100-to-1 leverage ratio, you can control a $10,000 position with only $100 of your own capital. However, leverage magnifies both potential profits and, crucially, potential losses. So it must be used. It must be used with extreme caution and a thorough understanding of its implications. Margin is the amount of money in your account that the broker requires you to set aside as collateral to open and maintain a leveraged trading position. It's not a fee, but rather a portion of your trading capital. This portion of your capital is locked up, while the trade remains open and is returned once the position is closed. A bull market describes a market where prices are consistently trending upward over a sustained period. In such markets, investors are generally optimistic and are often referred to as bulls due to their positive outlook. Conversely, a bear market refers to a market where prices are consistently trending downward. In these conditions, investors are typically pessimistic about future price movements and are commonly known as bears. These terms describe the overall prevailing sentiment and direction of the market, influencing trading strategies and risk appetite for many participants. 1.5. Trading sessions and hours. As we mentioned earlier, some financial markets, like Forex and crypto, operate almost continuously, providing trading opportunities around the clock. However, the level of activity is not uniform throughout the day or week. Markets are generally most active and liquid when their main, respective financial centers around the world are open for business. The four main global trading sessions are the Sydney session in Australia, which effectively opens the trading week for Forex. Next is the Tokyo session in Japan, which is the main Asian trading session. Following that is the London session in the United Kingdom, the main European session and often the largest in terms of volume. Finally, the New York session in the United States is the main American trading session. There are specific periods of overlap between these major sessions, which are usually the times of greatest market liquidity and volatility. Consequently, these overlap periods often present the greatest number of potential trading opportunities for active traders. The most important and widely watched overlap is between the London and New York sessions. For markets like stocks, the trading hours are more defined and typically correspond to the official opening and closing times of the specific stock exchange where those particular stocks are listed and traded by market participants daily. Understanding these trading hours and session overlaps helps you to effectively plan when to trade. It also makes you aware of the times of higher or lower market activity in the specific market or instrument you are focusing on, which can be crucial for strategy, implementation, and managing risk appropriately during your trading endeavors. And that's all for Module 1. You now have a solid foundational understanding of the different types of financial markets that exist, who the main participants are within them, and how these markets are primarily driven by the fundamental forces of supply and demand. You also learned key terminology and trading hours. Module 2. Trading Tools and Platforms. 2.1. Choosing a broker. A broker is your gateway to the financial markets, the entity that will execute your buy and sell orders. Choosing the right broker is one of the most important decisions you'll make as a trader, as it can significantly impact your experience and results. Let's look at the key factors to consider when making this selection. 2.1.1. Regulation and security. Regulation and security is, without a doubt, the most crucial aspect A regulated broker is supervised by a competent financial authority, which offers a level of protection for your funds and ensures the broker operates under certain standards of transparency and fairness. Look for brokers regulated by recognized entities in financially sound jurisdictions for better peace of mind. Some examples of top-tier regulatory bodies include the FCA in the United Kingdom, ASIC in Australia, and CISEC in Cyprus, where many European brokers are regulated. Others are FINMA in Switzerland, and in the United States, the NFA and CFTC for futures and forex, along with the SEC for stocks and other securities. Always verify the broker's license number directly on the regulatory body's official website. Be extremely wary of unregulated brokers or those regulated in tax havens with lax oversight, as the security of your funds should always be your absolute top priority. This cannot be overstated when making your final decision on a brokerage firm. 2.1.2 Account types. Understanding account types like ESING, STP, or market maker is important. Brokers use different execution models affecting order processing and costs. The main types include market maker or dealing desk brokers. These create a market for clients, meaning you trade against the broker as they set bid and ask prices, and may take the other side. This operational model can create a conflict of interest, though not all market makers are inherently bad, and they often offer fixed spreads as a feature. No dealing desk brokers, however, do not take the other side of your trades. Instead, they send your orders directly to liquidity providers, enhancing transparency for users. There are two main NDD types: ST, where orders are routed to liquidity providers and the broker might add a small markup to the spread as their profit. The other is EC, where orders interact with those from other market participants like banks, institutions, and fellow traders. ECN usually offers the tightest variable spreads and greater transparency, but often charges a commission per trade in addition to the spread. For many traders, ECN or STP models are preferable due to their transparency and fewer conflicts of interest, though market makers can suit beginners or those trading with small capital amounts initially. 2.1.3 Commissions, spreads, and operating costs. Commissions, spreads, and operating costs significantly impact profits, so understanding the fee structure is vital. Spreads, the difference between buy and sell prices, can be fixed, common with market makers, or variable, fluctuating with market conditions and common with ECN STP brokers. Naturally, lower spreads are generally better for the trader's overall profitability. Commissions are fees charged by some brokers, especially ECN types, per lot traded, in addition to the spread. Ensure you understand this amount clearly. Swap or rollover is the interest charged or earned for holding positions open overnight. Also, carefully consider any potential deposit and withdrawal costs, as some brokers do charge various fees for these services. Review all payment options and their associated costs thoroughly before funding an account. Finally, be aware that some brokers charge inactivity fees. If an account remains inactive for a specified period, it's crucial to compare the total costs among different brokers for your planned asset type and particular trading style before committing your funds. 2.1.4 Platforms offered. The platforms offered by a broker are also key. The broker provides the software necessary for detailed market analysis and efficient trade execution. Ensure the broker offers a platform that is stable, intuitive, and equipped with all the tools you will need for your trading activities. We'll discuss specific platforms in more detail shortly in this module. Other factors to consider include the quality of customer service available from the broker, the range of financial instruments offered for trading, any minimum deposit requirements that might be in place, and the leverage options provided. Always do thorough research, read reviews critically, and if possible, try the broker's demo account before depositing any real funds. 2.2 Main trading platforms. The trading platform is your operations center. It's where you'll spend most of your time analyzing charts, placing orders, and managing your positions. 2.2.1 MetaTrader 4/5. MetaTrader 4 and 5, or Mount 4, Mount 5, developed by MetaQuote Software, are arguably the most popular trading platforms globally, especially for Forex and CFDs. Their many advantages include being widely offered by most brokers, ensuring accessibility. They also feature a large number of built-in and customizable technical indicators for in-depth market analysis. Furthermore, MT4, MT5 support algorithmic trading via expert advisors and the MQL4, MQL5 programming language. They boast a relatively intuitive interface once you become accustomed to it, and are conveniently available for desktop, web, and mobile devices, allowing traders to stay connected to the markets from virtually anywhere at any time. Regarding differences between Mount 4 and Mount 5, MT5 is the more modern version, offering more timeframes, additional technical indicators, an integrated economic calendar, and access to a wider range of markets like stocks and futures. if the broker supports it. However, Mount 4 remains very popular due to its vast ecosystem of existing expert advisors. Many custom tools have been developed specifically for Mount 4 over the years by a large community. 4Forex and CFD trading. Both MetaTrader 4 and MetaTrader 5 are considered excellent and highly reliable options, catering to a wide range of trader preferences and needs in the financial markets. Your choice might depend on specific tool requirements. 2. TradingView has gained immense popularity, serving not only as a premier charting and analysis platform but also, increasingly, as a direct trading platform if your broker offers integration. Its notable advantages include exceptional, powerful, and highly intuitive charting tools that are favored by many traders across different experience levels worldwide today. For market study, it also features a large social community where traders can share ideas, scripts, and analyze. TradingView provides wide market coverage, including forex, stocks, crypto, futures, and indices. It boasts its own scripting language, PineScript, for creating custom indicators and developing unique trading strategies, tailored to individual needs and specific preferences of users. TradingView offers a very robust web version, easily accessible from any browser, and also provides comprehensive mobile apps for trading and analysis on the go. A potential disadvantage, when used as an execution platform, is that not all brokers are directly integrated for trading from TradingView, although the list of supported brokers is constantly growing. Consequently, many traders use TradingView primarily for its advanced analysis capabilities and then proceed to execute their orders on their respective broker's platform, such as MetaTrader 4 or 5. This hybrid approach allows them to leverage the best features of both systems for their trading activities and inform decision-making processes effectively. 2.2.3 Proprietary broker platforms. Proprietary broker platforms are those developed in-house by many large brokerage firms, and they can vary greatly in terms of quality and features offered. Some advantages include that they are sometimes very well integrated with the broker's specific services and may offer unique, specialized features or an interface designed for a particular trading type. However, there are disadvantages to consider. If you decide to switch brokers, you'll face the learning curve of a completely new platform. Additionally, their overall popularity and the extent of community support available may be lower compared to widely adopted platforms, like MetaTrader 4/5 or the increasingly popular TradingView charting and social platform. Some well-known examples of proprietary platforms include Thinkorswim, originally from TD Ameritrade, and now part of Charles Schwab, and Trader Workstation, commonly known as TWS from Interactive Brokers. Many CFD brokers also offer their own web-based platforms. The choice of platform will often depend on the broker you select initially for your trading. Your personal preferences regarding the user interface, available tools, and overall trading experience will also play a significant role in this decision. Most reputable brokers offer demo accounts, so you can thoroughly try out their platforms before committing any real capital, ensuring it meets your specific trading requirements and style effectively and comfortably. 2.3 Platform configuration. Charts, indicators, orders. Once you have selected a trading platform, you need to learn how to configure and effectively use its various features. The basic elements you will typically manage include charts, which are visual representations of price movements. On these charts, you'll learn to change the chart type, such as candlesticks, bars, or simple lines. You will also adjust timeframes, perhaps from minutes to hours or even days. Add a variety of technical indicators to aid your analysis, and draw analytical tools like trend lines, support levels, and resistance levels directly onto the charts. Indicators themselves are mathematical tools applied to price and/or volume data to help you analyze the market. These indicators can also assist in generating potential trading signals, and we will explore the main ones in the technical analysis module later. The Market Watch window is another key component. It displays the list of financial instruments available for trading along with their real-time bid and ask prices, keeping you updated constantly with market data. The Terminal or Navigator section is where you can view your open trades, review your complete trade history, check your account balance, and monitor your available margin. It also provides access to tools like custom indicators or expert advisors if you use them. Crucially, order placement is the functionality that allows you to open, modify, and close trades. It is highly recommended that you spend a considerable amount of time exploring all the features and functionalities of the platform you choose. Gaining a thorough familiarity with your primary work tool is absolutely essential for efficient and successful trading in the financial markets. Practice makes perfect in this regard, so dedicate sufficient time. 2.4 Types of orders. An order is essentially an instruction you give to your broker to either buy or sell a financial asset, and understanding the different types available is crucial for effective strategy execution. A market order, for instance, is an order to buy or sell immediately at the best available price in the market at that precise moment. It executes quickly, but the final price may vary slightly from what you saw, a phenomenon known as slippage, especially common in volatile market conditions. This type of order is generally used when the speed of execution is prioritized over obtaining an exact price. Next, a limit order is an instruction to buy or sell an asset. A limit order is to be executed at a specific price or better. A buy limit is placed below the current market price. The order will only execute if the market price drops to your limit price or a better one. This is used if you believe price will fall and then bounce higher from that level. Conversely, a sell limit is placed above the current market price. This order will only execute if the market price rises to your specified limit price or a better one. It's often used if you believe the price will rise to a certain level and then subsequently bounce lower, reversing its immediate direction of movement. With limit orders, you have control over the execution price, but there's no absolute guarantee the order will execute if the market doesn't reach your specified price level. A stop order is also an instruction for buying or selling at a specific price, but it is used differently than standard limit orders in its activation. Once the market reaches the designated stop price, the stop order then becomes a market order. Seeking immediate execution, a buy stop is placed above the current market price and is used if you believe that if the price rises to a certain level, it will continue to rise further, such as to enter a bullish breakout. A sell stop is placed below the current market price. This is used if you believe that if the price falls to a certain level, it will continue its downward trajectory, for example, to enter a bearish breakout trade. A stop loss is a crucial order type primarily used for effective risk management in all trading activities. It's an order attached to an already open position, whether it's a buy or a sell, designed to automatically close that position. If the price moves against you to a predetermined loss level, its main purpose is to limit your potential losses on any single trade, protecting your capital from significant drawdowns or unexpected adverse movements. A take-profit order is similarly attached to an open position, but serves to automatically close it when the price reaches a predetermined profit level. Its purpose is to secure your profits once your target is met. Essentially, it's a limit order that activates to close an existing position profitably and efficiently, without further intervention. A trailing stop is a dynamic type of stop-loss order. It is not fixed at a specific price, but rather at a certain distance, in pips or percentage, from the current market price. If the price moves in your favor, the trailing stop automatically moves with it, thereby protecting your accumulated profits during favorable trends. If the price then moves against you by the specified distance from its most favorable point, the position is automatically closed. This order is useful for letting profits run while still protecting against significant reversals. Mastering the use of these order types will give you greater flexibility and control over your trades and risk. 2.5. Using demo accounts for practice. Before risking a single cent of your real money, it is absolutely essential that you practice extensively on a demo account. A demo account is a simulated trading environment offered by most brokers. It allows you to trade with virtual money under real, or very similar, market conditions, providing a safe space to learn effectively. The benefits of using a demo account are numerous. Primarily, it allows you to familiarize yourself thoroughly with the trading platform, learn how to place orders, effectively use charts, apply various indicators, and much more, all without the fear of making costly financial mistakes. During this critical learning phase of your trading development, you can also test your trading strategies rigorously in this risk-free environment to see how they perform under different market scenarios and conditions. Furthermore, it's an opportunity to develop crucial trading discipline. Even though no real money is at stake, try to treat it as if it were by following your trading plan and risk management rules. Using a demo account helps you understand market dynamics by observing how prices move and how they react to various news events and economic data releases. This practice builds your confidence and practical experience before you transition to trading with real money, which involves significantly more psychological pressure and actual financial risk exposure to consider. Spend a considerable amount of time practicing on the demo account. While there's no fixed rule on how long this period should be, you should aim to be consistently profitable on demo, or at least fully understand why you're not, for a reasonable period, for example, a few consecutive months, before considering live trading with actual capital. Remember that demo trading can differ slightly from real trading, primarily due to the emotional factor. It's not the same losing virtual money as it is losing real money. Sometimes, there might also be slightly different execution conditions. However, despite these minor differences, it remains an invaluable and indispensable learning step for any aspiring trader. With this, we close Module 2. You now have a foundational understanding of the importance of choosing a good broker. You are also aware of the main trading platforms available to you, how to begin configuring them for your needs, and fundamentally, the different types of orders that will allow you to interact effectively with the market. Furthermore, you understand the crucial and indispensable stage of practicing thoroughly on a demo account before risking any real capital. In the next module, we will delve into one of the most widely used analysis tools by traders across the globe, the fascinating world of technical analysis. Let's continue on our learning journey to new concepts. Module 3, Technical Analysis 3.1, Introduction to Technical Analysis, Principles and Philosophy. Technical analysis is a method for evaluating financial assets and predicting their future price movements based on the study of historical market data, primarily price and volume. Unlike fundamental analysis, which focuses on an asset's intrinsic value, technical analysis centers on patterns and trends that form on price charts. The philosophy behind technical analysis is based on three fundamental premises, many of which come from Dow theory. Developed by Charles Dow in the late 19th century and considered the cornerstone of modern technical analysis. The first, and perhaps most important premise, is that the market discounts everything. The technical analyst believes that all relevant information, whether fundamental, economic, political, psychological, or any other type, is already reflected in the asset's price, making the study of the price sufficient, as good news increases demand and price, while bad news increases supply or decreases demand, causing prices to fall, all reflected in the chart. The second premise is that prices move in trends, meaning price movements are not random, but tend to follow a direction for a period. And once established, a trend is more likely to continue than to reverse. The technical analyst's goal is to identify these trends early to trade with them, with Dow theory classifying trends as primary, secondary, and minor. The third premise states that history tends to repeat itself, as price patterns observed in the past tend to repeat, because human psychology, which largely drives market movements, is consistent over time, allowing technical analysts to attempt to anticipate future movements by identifying historical patterns. Technical analysis is a tool, not a crystal ball. It doesn't guarantee success, but provides a framework for making trading decisions with a higher probability of accuracy if used correctly, and with good risk management. 3.2. Types of charts. Line, bar, and candlestick charts are the primary tool of the technical analyst, representing an asset's price evolution over time. The three most common types are the line chart, the symbol created by connecting closing prices over a period, useful for a quick trend overview, but offering little detail about intra-period price activity. The bar chart provides more information, with each bar representing a time period and showing for key data points, the open, the high, the low, and the close, where the vertical bar's length indicates the period's price range. Most popular today are Japanese candlestick charts, originating in 18th century Japan for rice market analysis, valued for their visual richness. Like bar charts, each candlestick shows OHLC prices featuring a real body representing the open-close difference, usually green-white if close is higher than open for a bullish candle, or red-black if close is lower than open for a bearish candle, and shadows thin lines above and below the body indicating the high and low prices for the period. The combination of body color and length, with wick length, forms patterns, offering clues about potential future price direction. We will focus primarily on Japanese candlesticks. 3.3. Interpreting Japanese candlesticks. Common patterns. Individual candlesticks and combinations can form patterns signaling trend continuation or reversal. Basic examples include the doji, which forms when opening and closing prices are virtually the same, resulting in a very small or non-existent body and indicating market indecision. Depending on its appearance, context, and wick shape, it can suggest a possible reversal. The hammer and hanging man patterns share a shape. A hammer appears at a downtrend S, end with a small body at the top and a long lower wick, little, no upper wick, suggesting sellers pushed prices down, but buyers recovered, indicating a potential bullish reversal. The hanging man, identical in shape, appears at an uptrend's end, suggesting a potential bearish reversal. Similarly, the shooting star and inverted hammer are related. A shooting star appears at an uptrend S, end with a small body at the bottom and a long upper wick, little no lower wick, suggesting buyers tried to push prices up but sellers took control, indicating a potential bearish reversal. The inverted hammer, same shape, appears at a downtrend's end, suggesting a potential bullish reversal, though usually needing confirmation. Engulfing patterns include the bullish engulfing, occurring after a down, consisting of a small bearish candle followed by a larger bullish candle whose body completely engulfs the previous candle's body, suggesting strong buying pressure and potential upward reversal, and the bearish engulfing occurring after an uptrend with a small bullish candle followed by a larger bearish candle whose body completely engulfs the prior candle's body, suggesting strong selling pressure and potential downward reversal. Many more patterns exist, and learning to identify them in context is vital. 3.4. Support and resistance. Identification and meaning. Support and resistance levels are fundamental concepts. Support is a price level where demand is expected to be strong enough to prevent further price falls. When price approaches support, it tends to bounce upward, visually appearing as a low where price previously bounced. Resistance is a price level where supply is expected to be strong enough to prevent further price rises. When price approaches resistance, it tends to bounce downward, visually a high where price was previously rejected. For identification, one looks for chart points where price has reversed multiple times. The more a level is tested and holds, the more significant it is. These levels can be horizontal or dynamic. Their meaning is that traders use them for entry decisions, stop-loss orders, and profit targets. When support is significantly broken downwards, it can become new resistance. And when resistance is significantly broken upwards, it can become new support, a phenomenon known as change of polarity or role reversal. 3.5. Trend lines and channels. Trend lines help visualize and confirm the predominant market direction. An uptrend line is drawn by connecting two or more rising lows. As long as price stays above this line, the uptrend is intact, and a break below can signal weakening or reversal. A downtrend line connects two or more falling highs. As long as price stays below, the downtrend is intact, and a break above can signal weakening or reversal. Channels form when price moves between two parallel trend lines, such as an ascending channel, a descending channel, or a sideways channel or range. Traders can trade within the channel or await a channel breakout. A trend line or channel's validity increases with more price touches without breaks. 3.6. Chart patterns. Chartism is the study of formations or patterns on price charts indicating trend continuation or reversal. Continuation patterns suggest a previous trend will likely resume after a pause. These include triangles, such as the ascending triangle, the descending triangle, and the symmetrical triangle. Falling highs, rising lows, converging, with breakout possible in either direction, often following prior trend. Other continuation patterns are flags, small rectangles tilted against the main trend after a rapid move. A bullish flag after an uptrend usually precedes another rise. A bearish flag after a downtrend precedes another fall. And pennants, similar to flags, but shaped like small, symmetrical triangles. Reversal patterns suggest the current trend is losing strength and likely to change. Examples of the double top forming after an uptrend where price hits a high, pulls back, rises to a similar high without surpassing it, then falls breaking the low between tops. And its mirror of the double bottom forming after a downtrend where price hits a low, bounces, falls to a similar low, then rises breaking the high between bottoms. The head and shoulders is a bearish reversal pattern after an uptrend with a first peak, a higher peak, then a third, lower peak, where the neckline connects lows between shoulders and head. A neckline break downwards confirms it. 3.7. Technical indicators. Technical indicators are mathematical calculations based on price and/or volume, used to confirm trends, identify overbought, oversold levels, measure volatility, or generate trading signals. Generally divided into categories. 1. Moving averages smooth price data to show trend direction more clearly. The simple moving average calculates the average price over a specific number of periods, while the exponential moving average gives more weight to recent prices, reacting faster to price changes. Common uses include identifying trend direction, acting as dynamic support or resistance, and generating crossover signals. 3.7. 2. Oscillators measure price, movement, momentum, or speed, usually fluctuating within a band. They help identify overbought, oversold conditions and detect divergences. The RSI measures price, movement, speed, and change, oscillating between 0 and 100. The stochastic oscillator compares the closing price to its price range over a period, also oscillating 0 to 100. The MACD has two lines in a history used to identify changes in trend, strength, direction, momentum, and duration. Crossovers between MACD and signal lines can generate signals. 3.7. 3 trend indicators help determine trend existence and strength. The ADX measures trend, strength. A reading greater than 25 usually indicates a strong trend, while less than 20 suggests a weak trend or ranging market, used with direction showing indicators. 3.7. 4. Volatility indicators measure asset, price variation. Bollinger Bands have a central MA and 2 outer bands. Bands widen with increased volatility, narrow with decreased volatility, with prices tending to stay within, and touches on bands can indicate support resistance or extremes. The ATR measures market volatility, useful for stop losses or position sizing. Avoid overloading charts and remember indicators are confirmation tools, not infallible predictors. 3.7. 3.8. Volume and its importance in analysis. Volume, representing the total amount of an asset traded during a specific period, is a powerful confirmation tool. For trend confirmation, an uptrend is stronger with increasing volume, and a downtrend more convincing if volume increases on declines. For breakout confirmation, a breakout from support, resistance, or a chart pattern is more reliable with significantly high volume. Low volume may indicate a false breakout. For exhaustion detection, if an uptrend continues but volume decreases, it may signal trend weakening. Volume divergences occur when, for example, price makes a new high in an uptrend, but volume is lower than at the previous high, a potential sign of weakness. Volume isn't always available or reliable in all markets. 3.9 Fibonacci Levels. Fibonacci tools, based on Leonardo Fibonacci's numerical sequence. Use derived rate to identify potential support, resistance. Fibonacci retracements identify how far price might retrace after a significant move before continuing the main trend, drawn from an impulse's start to end. The 38.2%, 50%, and 61.8% levels are most watched as potential support or resistance bounce zones. Fibonacci extensions, project potential, price targets once a retracement ends, and price resumes trend, helping set profit targets. Fibonacci works best, combined with other support resistance levels and technical signals. 3.10 Multiple timeframes. Traders rarely use a single timeframe. Multiple timeframe analysis involves looking at the same asset on different charts. The higher timeframe identifies the main trend and key long-term support resistance. An intermediate timeframe refines the trend and seeks pattern setups within the main trend. A lower timeframe fine-tunes entry, exit points. The idea is to align signals across timeframes. For instance, if daily trend is bullish, look for buy signals on 4-hour and 1-hour charts. Trading against a higher timeframe trend is usually riskier. And this concludes our intensive Module 3 on technical analysis. We've covered a great deal of concepts, from basic principles to specific tools and techniques. Remember that technical analysis is both an art and a science. It requires a lot of practice, observation, and the ability to interpret information in the context of the market. Don't feel overwhelmed if it seems like a lot at first. Review these concepts, practice identifying them on real charts, and gradually they will become more intuitive. In the next module, we will explore the other major pillar of market analysis, fundamental analysis. Let's move on. 4.1 Introduction to Fundamental Analysis. Fundamental analysis is a method of evaluating the intrinsic value of a financial asset by examining related economic, financial, and other qualitative and quantitative factors. While technical analysis focuses on what the price is doing and when it might move, fundamental analysis tries to answer why an asset might be worth more or less to investors. The main goal of fundamental analysis is to determine if an asset is overvalued or undervalued relative to its perceived true value in the market. If an asset is undervalued, meaning its current market price is lower than its calculated intrinsic value, a fundamental analyst might consider it a good buying opportunity for potential future gains. They would expect the market to eventually recognize its inherent value, leading to the price rising over time. Conversely, if an asset is overvalued, with its market price being higher than its intrinsic value, it might be considered a selling opportunity, or at least a valid reason to avoid buying that particular asset. At present, the expectation in such a scenario is that the price will eventually fall to align more closely with its real, underlying value. Fundamental analysis can be effectively used by both long-term investors looking for sustained growth and also by traders who focus on short. Although traders often concentrate more on the short to medium-term impact, traders often focus on the impact of economic data releases and significant global events. For traders, fundamental analysis primarily helps understand the underlying economic forces that can cause significant and often sudden price movements, especially around the time of important economic news releases, which can create considerable market volatility for various assets. The specific factors analyzed in fundamental analysis vary widely depending on the type of asset being evaluated. For stocks, analysts examine company financial statements, including balance sheets, income statements, and cash flow statements. They also assess management quality, competitive position in the industry, sector growth prospects, and broader macroeconomic factors influencing performance. For currencies, often referred to as forex, macroeconomic indicators of different countries are key. These include interest rates, inflation figures, employment data, gross domestic product, central bank policies and statements, political stability within nations, and international trade flows between countries, all of which can influence exchange rate movements significantly. For commodities, the analysis centers on supply and demand factors, current inventory levels, prevailing weather conditions, especially for agricultural commodities like corn or wheat, influential geopolitical events, particularly for oil prices, and the overall strength or weakness of global economic growth, which impacts demand for raw materials across various industries worldwide. For cryptocurrencies, analysts might examine the project's the underlying technology and its innovation, the experience and reputation of the development team, the rate of adoption by users and businesses, the tokenomics or token economy, and the evolving regulatory environment which can heavily influence market sentiment and adoption. 4.2. Main economic indicators. Economic indicators are essentially statistics that provide insights about the economic activity of a specific country or an entire region. Their release can have a very significant impact on financial markets, especially the forex market, and often also on stocks and major stock indices, creating trading opportunities and potential risks for participants. Here are some of the most important economic indicators that traders and investors closely monitor. Gross domestic product represents the total monetary value of all goods and services produced within a country's borders during a specific period, usually reported quarterly or annually. It's considered the broadest indicator of a country's overall economic health. A growing GDP is usually viewed as positive for the country's currency and its domestic stock market performance. Interest rates and monetary policies, which are set by central banks like the Federal Reserve in the US or the European Central Bank in the Eurozone, are also critically important for market direction. Interest rates represent the cost of borrowing money. Higher interest rates tend to attract foreign capital from investors seeking higher returns, which can consequently strengthen the country's currency. However, they can also make credit more expensive for businesses and consumers, potentially curbing investment and consumption, which could be negative for stocks in general. Conversely, low interest rates can stimulate economic activity, but may weaken the currency as returns become less attractive. Monetary policies encompass decisions on interest rates, as well as asset purchase programs like quantitative easing or asset sales programs known as quantitative tightening. Statements and speeches by central bank officials are very closely. These communications are closely watched by market participants for any clues about future policy directions and potential shifts. Inflation, typically measured by the Consumer Price Index, gauges the rate at which the general level of prices for goods and services is rising, and consequently, how purchasing power is diminishing for consumers over time. High and persistent inflation can be detrimental to an economy. Central banks often respond by raising interest rates to combat rising inflation, which, as we have previously discussed, can significantly affect currencies and other financial markets. The Producer Price Index is also an important inflation indicator, but it reflects costs from the perspective. Of producers rather than consumers, offering insights into inflationary pressures earlier in the supply chain. Unemployment rates and employment data, such as the non-farm payrolls report in the U.S., are key indicators of labor market health. The unemployment rate is the percentage of the labor force that is jobless, but actively seeking employment. A low unemployment rate is generally considered a sign of a strong and healthy economy. The non-farm payrolls is a monthly U.S. report that measures the change in the number of employed people during the previous month, specifically excluding the farming industry from its calculations. It's a highly watched indicator and can cause great market volatility upon its release. Strong employment data is usually positive for the U.S. dollar and U.S. stocks. Consumer confidence and business sentiment indicators, such as the Purchasing Managers Index, also provide valuable economic insights. Consumer confidence measures consumers' optimism about current and future economic situations. A confident consumer tends to spend more, thereby boosting overall economic activity. The PMI is an indicator based on surveys of purchasing managers in both the manufacturing and services sectors. A reading above 50 typically indicates expansion in the sector, while a reading below 50 suggests contraction. It's considered a good leading indicator of a country's economic health and future prospects. The trade balance is the difference between a country's total exports and its total imports of goods and services. A trade surplus, where exports exceed imports, can be positive for the currency, while a persistent trade deficit can be negative. Retail sales figures measure the total sales of goods by retailers within an economy. It's an important indicator of consumer spending habits, which is a key driver of overall economic activity and growth. Lastly, industrial production measures the output of factories, mines, and utilities, reflecting the strength and activity level of the manufacturing sector. 4.3. Economic calendar. How to read and interpret it. An economic calendar is an absolutely essential tool for any trader who incorporates fundamental analysis into their It meticulously lists upcoming economic events, such as the release of the indicators we just mentioned, scheduled speeches by central bankers, and other relevant news, along with their precise scheduled dates and times for release. Key features typically found on an economic calendar include the specific event name, for example, U.S. unemployment rate, or ECB rate decision. It also shows the country or region to which the economic data refers. The exact release time is provided, and it's crucial to make sure this is set correctly to your local time zone. Many calendars also rank events by their potential market importance or impact, often indicated by colors, stars, or a simple low, medium, or high rating. The actual value of the indicator is displayed once it's officially released. The forecast or consensus shows the average expectation of analysts for that indicator's outcome before the release. The previous value shows the indicator's result from the prior release period, providing a benchmark for comparison. For interpretation, the market's reaction to economic data depends not only on the absolute number itself, but also, very importantly, on how it compares to the market's expectations, which is reflected in the consensus forecast provided. If the actual data released is better than what was forecasted by analysts, it is usually considered positive for the currency or stock market of the corresponding country. For example, if GDP grows more than expected. Conversely, if the actual data is worse than forecasted, the market reaction is usually negative for that currency. For example, if unemployment rises more than was anticipated by market analysts, if the actual data released is in line with the forecast, the market impact may be limited, as the market might have already priced in, or anticipated, that specific outcome before the official announcement was made to the public. It's absolutely crucial to be aware of the economic calendar, especially if you have any open trades, or if you plan to open any new positions near the time of a major data release, as market volatility can increase dramatically and suddenly. Many traders prefer to avoid trading right during high-impact news releases due to the uncertainty. Due to uncertainty and the increased potential for slippage, where orders get filled at unexpected prices. This cautious approach helps manage risk during periods of heightened market unpredictability that often accompany significant economic announcements from various global entities or specific national statistical agencies around the world today. 4.4. Impact of news and geopolitical events on markets. Besides regularly scheduled economic data releases, financial markets are also very sensitive to unexpected news and various geopolitical events. These can include things like elections and political changes, where unexpected election results or sudden political instability can create significant uncertainty and directly affect currencies and local stock markets across different regions globally. Conflicts and wars, such as armed conflicts between nations, can significantly impact commodity prices, especially for crucial resources like oil. They can also increase global risk aversion, often favoring safe haven assets like gold or the US dollar, and affect the stocks of defense companies or related industries that might benefit or suffer. Natural disasters can severely affect agricultural production, disrupt global supply chains, and result in significant economic costs for the affected regions and potentially beyond. Trade agreements or disputes, including changes in trade policies, the imposition of tariffs, or new agreements between countries, can influence international trade flows and the currencies of those nations involved. Pandemics or major health crises, as we have seen with the widespread impact of COVID-19, can have a massive and far-reaching global economic impact affecting nearly every sector and market. These types of events are, by their very nature, largely unpredictable, and their resulting impact on markets can be both rapid and severe. Staying well informed about global current events is an integral part of the job for any trader who effectively uses fundamental analysis in their trading strategy and decision-making processes. This awareness helps anticipate potential market shifts and manage associated risks more proactively, contributing to better overall trading outcomes in the long run. 4.5. Market-specific fundamental analysis. While the general principles of fundamental analysis remain the same, the specific focus of the analysis tends to vary by the particular market being examined. For stocks, quantitative analysis involves examining the company's detailed financial statements, such as the balance sheet, which shows assets, liabilities, and equity at a point in time. The income statement details revenues, costs, and profits over a period. The cash flow statement tracks cash inflows and outflows. Financial ratios, such as PEP-B debt-equity ratio, and ROE, among others, help compare companies and assess their financial health and current market valuation. Qualitative analysis for stocks considers factors like management, quality, and experience, the company's business model, and its sustainability, any competitive advantages or economic moat it possesses, brand strength and recognition, industry-specific risks, and the prevailing regulatory environment that might affect its operations or profitability in the future for investors. Growth prospects are also evaluated, looking at the potential for future revenue and profit growth for the specific company, for the broader sector in which it operates. For Forex, key fundamental drivers include interest rate which are one of the main long-term drivers of exchange rates, as capital tends to flow to country. Capital flows to countries with higher interest rates, adjusted for risk. Comparative macroeconomic health involves comparing key economic indicators such as GDP, inflation, and employment figures between two countries to determine the relative strength or weakness of their respective currencies against each other in the global foreign exchange market effectively. Central bank policies, including official statements, economic projections, and specific actions taken by central banks are crucial. The tone of a central bank, whether it's hawkish, indicating a restrictive stance, or dovish, suggesting an accommodative policy, is a vital factor for currency traders to consider. Capital flows and the balance of payments also matter. These reflect investment and trade movements between countries. Global risk sentiment plays a role too. In times of widespread uncertainty, currencies considered safe havens, like the US dollar, Japanese yen, or Swiss franc, tend to appreciate. Meanwhile, riskier currencies, such as those of emerging markets or commodity-linked currencies, may depreciate. For crypto, what's often termed fundamentals or on-chain analysis involves examining the project's white paper and its stated value proposition. What problem does the project aim to solve, and is it a viable and necessary solution in the current market? The team and community are also assessed, looking at the experience and reputation of the development team, the strength and activity level of the user and developer. Community surrounding the project are also important considerations. Tokenomics, which refers to the token economy, includes factors like the total supply, circulating supply, inflation or deflation rate, token distribution model, and the actual utility of the token within its specific ecosystem or platform. Adoption and use cases are critical, looking at the number of active users, the transaction volume on the network, any partnerships with established businesses, and the integration of the cryptocurrency into real-world applications. Technological development, including progress on the project's roadmap, network upgrades, and code security, is also thoroughly scrutinized by analysts. On-chain analysis involves metrics extracted directly from the blockchain itself. These can include the number of active addresses, overall transaction volume, wealth distribution among holders, hash rate for proof-of-work coins, or the amount of stake for proof-of-stake coins, among other data points that provide insights into network health and usage. The regulatory environment, encompassing news and decisions regarding cryptocurrency regulation in different countries, can also significantly impact prices and adoption. Fundamental analysis, regardless of the market, requires diligent research, considerable patience, and the ability to synthesize a lot of diverse information effectively to form a coherent view for decisions. For a trader, fundamental analysis can provide the essential context behind the price movements seen on charts and can help anticipate potential trend changes or periods of high market volatility. It offers a deeper understanding of the underlying drivers that affect asset valuations over various time horizons, complementing other analytical approaches. With this, we conclude Module 4 on fundamental analysis. We've looked at what it is, explored key economic indicators, discussed how to effectively use an economic calendar, understood the impact of news and geopolitical events, and seen how to apply these fundamental principles to different types of financial markets for better trading decisions. It's important to remember that many successful traders skillfully combine elements of both technical and fundamental analysis in their overall trading strategies. Neither approach is inherently superior to the other. They are simply different tools for analyzing the complexities of the financial markets. Each offers unique perspectives and valuable insights for traders. In the next module, we will address an absolutely critical topic for long-term survival and ultimate success in trading: effective risk management strategies and techniques. Let's get to it and continue building our trading knowledge.